You're listening to the Financial Source podcast on YouTube.
Welcome to today's deep dive. We've got a fresh stack of your financial market reports right here in front of us.
Yeah, a really interesting stack today.
Right, and our mission today is basically decoding the snapshot of global markets, because right now they're caught in this very cautious tug of war. On one side, you have highly anticipated economic data, and on the other, some incredibly complex geopolitical chess moves.
Okay, let's unpack this because right now, institutional investors are sidelined in a major way.
They are. The broader market has essentially, it's stalled out completely. Capital is firmly parked.
Yeah.
I mean, the street is collectively holding its breath for Friday's NFP print to drop, the Non-Farm Payrolls.
Exactly. Nobody wants to commit serious capital right now.
Right, or rebalance portfolios.
Right.
Not before seeing the actual strength of the U.S. labor market, especially given our current macro environment.
And you can really see the ripple effect of this holding pattern across the entire board. I mean, U.S. Treasury futures are absolutely flat.
They're barely moving at all. The U.S. dollar index slipped a mere 0.1%, and the major European pairs are just inching along.
Very slowly.
The euro managed a very modest recovery to the 1.160 level, and the pound bumped up to around 1.3300. We are looking at a classic macro holding pattern where the major players are totally frozen.
Yeah, but while the majors are quiet, the margins are where the real action is happening today.
Right, and speaking of the margins, there is this stark anomaly buried in these reports. The Australian dollar completely ignored the broader market pause.
Jumped right past.
It jumped 0.5% and significantly outperformed the rest of the G10 currencies.
What's fascinating here is that the Aussie's momentum isn't just random. It's being fueled by a dual-engine setup.
Which is?
First, industrial metals are rebounding across the board. Copper alone is up 0.9%, which injects immediate life into commodity-linked currencies.
Right, that makes perfect sense.
And second, and this carries much more weight, there is intense speculation that the Reserve Bank of Australia is actually gearing up to hike interest rates this month.
To fight inflation, which is a massive divergence from the broader global narrative.
Exactly. While other central banks are signaling pauses, Australia is still actively battling persistent domestic inflation.
So the market is pricing in the reality that the RBA might have to just go it alone to cool off their economy.
Which instantly makes the Aussie a more attractive yield play for traders looking for, any kind of movement.
Yeah, that yield advantage is a powerful magnet.
It is, but capital flow right now is also being heavily dictated by risk aversion.
Here's where it gets really interesting, though. If we pivot to the commodities market, we're seeing some wild diverging reactions to the geopolitical landscape.
The gold numbers are wild.
Gold just surged by 0.8%, breaking past a staggering $5,100 per ounce.
Wow.
That is pure safe haven demand, driven entirely by the ongoing conflict involving Iran. Institutional money is basically buying insurance.
Yeah.
But simultaneously, oil is selling off. West Texas Intermediate fell 2% and Brent crude dropped 1.4%.
Normally, Middle East tensions inject a massive geopolitical risk premium into the energy sector.
Right.
But the market is actively pricing in back-end diplomatic workarounds instead of a traditional supply shock. If we connect this to the bigger picture, the mechanics of that decoupling start to make sense.
It's all about these unprecedented geopolitical maneuvers.
Exactly. They are artificially cooling those oil prices.
Yes, sir.
According to your reports, China has actually stepped in to negotiate directly with Iran.
With the explicit goal of guaranteeing safe shipping through the Strait of Hormuz.
By securing that specific maritime choke point, Beijing is effectively deflating the immediate risk premium that would normally send Brent sky high.
And those diplomatic workarounds aren't just happening in the Middle East. The data details a highly specific 30-day waiver just issued by the U.S.
This is a huge detail.
This waiver explicitly allows Russian oil, which is currently stranded at sea due to sanctions, to be sold and delivered directly to India.
It's basically a geopolitical hall pass designed to keep millions of barrels flowing into the market.
Yeah.
The logistical complexity of that waiver highlights just how delicate the balance is right now. You have massive tankers idling in international waters, unable to offload, which threatens a localized supply crunch.
So by granting this 30-day window, policymakers are strategically bypassing their own embargoes just to prevent an energy spike in Asia.
A spike that could easily cascade into the broader global market.
So what does this all mean? If we zoom out on your reports, the prevailing theme is a macro holding pattern.
Definitely.
Global markets are range-bound, and capital is parked on the sidelines waiting on U.S. labor data to dictate the next major trend.
While at the same time, backdoor diplomacy and strategic loopholes are acting as temporary shock absorbers for global commodities.
Exactly.
And this raises an important question for you to mull over. If fragile temporary workarounds like a mere 30-day U.S. waiver for stranded Russian oil or behind-the-scenes negotiations in the Strait of Hormuz are what is currently keeping global energy prices in check, how violently will the market react when those short-term band-aids inevitably expire?